This is Satya Pradhuman, and welcome to the Cirrus Foundation series. This series centers on research tools that are used in the equity markets. In other words, how do we build the models we use and publish? In this episode, Nic Palar walks through the concept of crowding and how to model such a market phenomena. In the last few years, we've certainly become more aware of how 3, 4, 5 stocks could lead the full-on market, present potentially the best returns. Taken to some extreme, this seems to point to a more volatile markets. Over the years, Cirrus Research has been modeling the crowding of markets and the implications of such events. At this point, I'm going to turn it over to Nic Palar.
Thanks for the introduction, Satya. I'm Nic Palar. I'm going to take over the reins from here and introduce our crowding model, the Cirrus Polarization Quotient, or CPQ. So first, a little motivation. What is crowding? Why do we care? So I think this is a chart of the indicator, the CPQ, and what immediately stands out is this purple area in the late 90s, early 2000s. This is the famed NASDAQ tech bubble, a period of extreme polarization in the marketplace, when speculative tech stocks began to encompass a larger portion of the market capitalization, and were also accompanied by very stretched valuations. This, of course, ended unfortunately with a market collapse that had implications well beyond just the speculative tech stock silos of the market. So this indicator is an attempt to get at crowding from this perspective. When within equity markets, this crowding really becomes something that's dominating the market, right? You can have periods where maybe a sector is stretched or kind of idiosyncratic portions of the market run into this issue of crowding. So maybe you could think of the quant quake in 2007, when certain quantitative strategies were crowded, and as they had to be unwound, that became an issue for people running those quantitative strategies. The CPQ, I think, is something that really isolates a more narrow, a broader part of the market, where kind of the implications of this crowding, it's something that wherever you are in the marketplace, you need to start paying attention. So in addition to this large cap CPQ, which is our primary indicator for crowding in U.S. equity markets, and because of the importance for U.S. equity markets worldwide, certainly something to look at, even if you're primarily a global investor. We also have versions for regions across the world, and we have a small cap and mid cap version, which is slightly modified, because when you look at the construction of our large cap CPQ, it takes the median PE of the hottest stocks in the market. For small and mid cap, we instead look at a measure of sales. So we look at EV to sales rather than PE, because of the composition of smaller firms. So what does hot stocks mean, or leadership? These are terms that are thrown around in investment strategy all the time. There are a lot of right answers to this problem, and we've decided to take one of the simplest versions, which is the top decile by 12-month price change. So essentially, the stocks that have gone up the most over the past 12 months, this is our momentum basket. We compare the median PE of that momentum basket to the Cirrus large cap index. If that premium of momentum stocks is more than one standard deviation above the average, then we view the marketplace in speculative territory. What are the implications for investment when the CPQ is giving a crowded or speculative reading. It offers somewhat defensive advice. So quality and value are by the way we look at factors, are the two favorite factors. Business momentum and price momentum, on the other hand, offer inferior returns, conditional on a speculative reading from the CPQ. So, kind of going back to this chart here, as partway through the pandemic, we started to see the CPQ start to hit extreme levels. This is a message to be cautious, and you can use this as a risk management tool. You can use it as a signal to rotate in and out of sectors as you sort of look at what is comprising the large cap CPQ basket. And I think most importantly, going back to this chart, it means that, leaning towards value, leaning towards quality, when the markets are in a speculative phase, offers quite a bit of protection. So just to recap, the CPQ is a measure of large cap market crowding. We have versions of this for markets across the world, as well as mid caps and small caps. The indicator in general looks at the premium of hot stocks versus the broader market. Our favored indicator, the large cap CPQ, specifically looks at the premium of large cap stocks, hot stocks, to the broader market. Following the period of extreme crowding, expected returns should be lower, and quality and value has an edge when the CPQ is in cautionary territory. So this is an overview of our CPQ, a key tool in our investment process and risk management. And I hope that this is helpful.